Good afternoon, everyone. My name is Timothy Lee, and I'm a mining analyst here at Red Cloud Securities. We welcome Chris Doornbos, President and CEO of E3 Metals Corp. He will speak to us about E3's lithium projects in Alberta. Chris, you have 15 minutes, and then we'll have a 5-minute Q&A at the end of the session. And attendees, please feel free to ask questions using the Q&A link below. Take it away, Chris.
Excellent. Thank you very much, Tim. Chris Doornbos, I'm the CEO of E3 Metals. E3 Metals is a lithium development company based in Alberta. And I really like to start with this picture because it really outlines to me what E3 is all about. If you peel enough of the layers back from E3, we look similar to an oil and gas company here in Canada's oil and gas hub. We produce a fluid from an aquifer that has been well understood and well developed. It's called the Leduc. It was discovered in 1947 by Exxon. They've been developing it since. In our area, it's been producing since the 60s. So that means 60 years of production history for this asset. Alberta knows how to produce the fluids out of this. When it was discovered, it was a very small amount of oil and mostly brine, and that lithium is in the brine, and that has been ignored until recently. And what E3 has done is developed an extraction technology that enables us to achieve economic value from this aquifer, which we've outlined now in our preliminary economic assessment that came out in November, and has been a catalyst for a lot of the movement for E3 over the past 6 months. And I'll take you through that today. Forward-looking statements. So E3's growth strategy that we outlined a couple of years ago is now fully in place. The technology that we have developed is a primary extraction. It removes the lithium from the brine. We've been developing this for 4 years. It is now in its final stages of prove-out. We are building a pilot prototype in the lab, as we've outlined in some news announcements recently, and that will lead us to a pilot that will go into the field, we're hoping, next year. Along with that, I mean, a key differentiator in the market, looking at the lithium market itself, is not all lithium is created equal. And most of the production today from the back of a mine does not produce battery quality products. E3's project looks to produce battery quality products directly from the back of the mine, which means that we will be able to capture the full value of that lithium, because lithium with high impurities is discounted very heavily. Being in Alberta provides us the opportunity to develop this project with operations that mirror oil and gas, which means we have the skill set and the service companies here in South Central Alberta to develop this project, backed on this resource that we've developed. Right now, just 1/3 of the ground we hold is the 7th largest resource globally from publicly available data, 7 million tons of lithium in the ground today. The company is fully funded to complete the pre-feasibility study as we've outlined it so far. We've got a great DLE great ESG story, and a very impressive team. On a high level, most of the people on this slide, save for myself and Liz, have joined the company since January. And the catalyst for that has been the PEA, a maturation of E3 stock price, and then the capital raising of a little over $14 million between October and February. And so E3 has been actively staffing to get the right people on the team to build this commercial project here in Alberta. The most recent of which was Jonathan Nielsen on the far right. He worked on Ora Carberry's project. He came from FL Schmidt. Very hard to find lithium process experts in this world. And he started on Monday. So he fills the role of Director of Technology. A couple new directors. So as I mentioned, E3 since October has, if you look at our stock price, you can see this. We really have gone through this maturation. Part of that has been maturing the board. We brought on John and Kevin recently, oil and gas expertise, John on the capital market side and Kevin from the operations side, oil and gas operations. We've also had Brad Wall join our advisory board, former Premier of Saskatchewan. When you look at the lithium market, the big thing to note is that the current price of lithium hydroxide is somewhere in around the $12,000 to $14,000 range, depending on the source of your information. All lithium right now that goes to the battery manufacturers is direct sale contracts. And there's two big catalysts in my mind that have solidified the lithium industry. The first is that the lithium-ion battery has now become the battery of choice, and it's solidified itself with 2.2 terawatts of manufacturing capacity, either in construction or constructed today, which is a stat out of benchmark, and that's a huge number, which means we're all in on lithium. The other thing that has been a big catalyst, and everyone would have noticed that in the past 6 months or 8 months, and more specifically during the fall of 2020 up until January, February, almost every OEM has committed to electrifying either part or its entire fleet. And that's all the majors. So when you look at it from that perspective, now we have a very robust EV market and all based on the lithium battery. So for us, what that means is that there's going to be a bit of a supply demand crunch coming, and it's going to be short-lived. This is not our data. I believe that the sort of supply crunch will probably be a bit shorter than they're outlining here. But what it really means is that the price of lithium is going to go up in the short term. But when you look at the PEA that E3 put out, we used 14,000 a ton. So we used a realistic price to outline a $1.1 billion project. And that's battery quality lithium hydroxide that we're producing. It's an $820 million after tax, $600 million capex, which is paid back in 3.4 years using 14,000 per ton. So if that goes up, that payback period reduces pretty drastically. The big number to note is our operating cost per ton. We're on the bottom end of the lower quartile here with E3's project at $3,600. We've seen reports that the hard rock being converted into hydroxide in China, it cost metric about 8,000, 8,500 per ton. So well under that sort of industry benchmark. This is what the project looks like. As I said, it mirrors oil and gas. You have a series of wells from small pads producing the brine. That brine gets pumped into through an underground pipeline to a central facility where we remove the lithium using our direct extraction process, and then the brine goes right back into the aquifer. So what that means, it's the closed loop system. There's no exposure of this water to the surface at all. We make a lithium concentrated solution with our DLE technology, and then we purify that into lithium hydroxide using more conventional industry technology. On the technology process that we've developed, this is proprietary to E3. We've developed it. We've spent the past 4.5 years perfecting it. Now we're just putting the commercial side to it, which is the pilot plant that we're going to demonstrate how this works. And effectively, it's a water softener. And in a water softener, you have a series of beads that go into a tank. And those beads take calcium out of the water in exchange for sodium. So that's effectively what we're doing here. We take lithium out of the water and we exchange it. Every so often, these beads fill up with whatever you're trying to take out. For us, it's lithium. We backwash off that lithium when we create a concentrated solution. Because the material is so highly selective for lithium, we get an incredibly high purity, and that enables us to go to battery quality hydroxide directly from the back of this process. And that's one of the biggest advantages that we have. It's also a very passive, low energy intensive process and scales very readily. With the prove out of our technology, I think that the resource for E3 actually provides the biggest blue sky. The technology is obviously very valuable. When you look at it from the perspective of a 7 million ton resource, and as I mentioned, that's just 1/3 of the ground. So the white outline is the Leduc Aquifer. The dark blue shaded areas are where we have resources. And so that 7 million tons can produce at brine rates at the equivalent of 150,000 tons of lithium hydroxide per year, and that can run for 35 years. And then we can expand the resources beyond that as well. So this adds a huge potential for blue sky. With the technology prove out, we have access to this entire resource, and this sits in Alberta between Calgary and Edmonton. So it's in the south central part of the province, very easily accessible. The other part of this is obviously and looking at it from the perspective of lithium going into green cars, the ESG perspective, especially to our clients, our potential purchasers, as well as the major funders that might back us to build this process facility, we'll look at the ESG footprint. So inherent to DLE are things like we don't have a tailings pond, we don't have an open pit mine, we don't have a solar pond, We don't use fresh water in the process. And we use a very small amount of land, only 3% relative to like a mine or a salar. And that's because we just have small well pads with a central facility, the extraction facility. The one thing that the company's aiming towards is a net zero carbon emissions. And I think this is really important because the carbon footprint is probably the biggest part of ESG that people look at. We're going to do that by implementing wind power, which is on site already. If you look at some of the pictures behind me or on this slide deck, you'll see that wind farm. And we'll back a baseload power with natural gas that will sequester the carbon using Alberta technology. So that's how we'll get to a net zero carbon. One of the big pieces of this project is our path forward. I'm going to take you through that here to the next slide. But looking at this from the perspective of our peers in the space, I think it provides a bit of context to E3. So right now we have a market cap hovering around $100 million Canadian. We've got a reserve of about 7 million tons. A good comparison for us is Standard Lithium. They've recently had a big run. And I think even now this market cap is out of date. They've gone up since then. When you look at us from what they've done, they've developed a DLE technology as well. Similar process. When you look under the hood, it is different, but it is a similar process, and it works similarly, and it is DLE. We have similar recovery metrics. They have higher grade, but we have higher recovery, and so the two sort of end up in the wash. A big difference between us, however, is that we own our resource base where they are joint venturing in. And I think that the reason that's important is it looks at where we are at the stage of our project. So they have piloted, they've been successful. It's a good example for all up and coming DLE projects because they are proving out DLE for the space right now. And they're obviously obtaining the value from that prove out. E3 is about 18 months behind them in that stage. So we hope to be piloting next year, so 18 to 24 months behind. And I think that gives E3 a really nice runway of where we expect to go as we grow this company. We do that technical prove out and we look to put this into commercial production. And from that light, where E3 is headed right now, the first and foremost priority for the company is to de-risk this DLE technology. We talk a lot about this, but it is absolutely fundamental, obviously, to the business, and that is well down that path. So the first point on here, the chemical optimization is done. The research, we announced a couple of weeks ago that the research and development on this is wrapped up, which effectively means is that we have our final product that we have developed. And what that really is as I mentioned, it's like a water softener, which are beads in a tank. So what we've developed is that bead. That's our proprietary technology. The tank that houses that bead, we're going to deploy more conventional ion exchange systems that have been used in this world for the past 30 to 50 years. So we'll be looking for conventional processing, but the material that we've developed is proprietary to us. So that puts us at the lab pilot stage, which is here the second point. We expect that to be wrapped up by the end of this year, and then we'll be working on the construction of the pilot and getting that out as soon as it's built. We're also working on permitting that pilot location right now. While we work on that, we're developing our aquifer management plan, which is really upgrading our resources to measured and indicated so that we can proceed with the feasibility study. And I should mention that the DLE technology recently received a grant from Alberta Innovates for $1.8 million to get that off the ground. The last thing that we're working on right now is lithium hydroxide from a commercial scalable process. So we've made lithium hydroxide in our lab, but we're going to vendors who develop and manufacture these processes. And we're talking to them about designing a process for us. And we aim to, by the end of this year, have battery quality lithium hydroxide produced using one of those scaled down commercial processes to demonstrate the viability of the full process. All of that culminates in a pre-feasibility study that we aim to have out hopefully by the end of next year. When you look at E3, and I think the stock chart tells the best story of E3. If you look at here on the left, we traded in and around that 40 cent mark for years while we did technology prove out, working through a very bear market in lithium. In the fall, we started to see a bit of movement in the market. We saw a small movement in the stock. We took that opportunity to raise some capital. We raised just over $1 million. And then we got our PEA out, and that PEA got us up to, we saw us trading to $1.80 on the back of that news, which was fundamental because I think that we were discounted because the grade of our project against a Solar grade is a bit lower. And we were discounted because of that. But a DLE process, that grade that we have is actually quite high. And that question always comes down to economics. And with producing the economics and outlining the project has after tax an $820 million US value at that average grade, demonstrated that the technology mixed with the grade made a very valuable project for E3. Then we had our partner step out of the project to focus on another asset that they had committed to, which was fine for us. We took all of that work that they were doing and that intellectual property back to E3. We opened up a facility in October. In February. In early January, the stock started to move again, started to come back and rebound from that PA level. We did a $8 million institution-based raise, and from there we traded up to $5.35. We now trade about $1.75, and I think most of that is from the two big placements we did. We saw some free trading paper come back at us, and I think we've sort of chewed through most of that. And looking at E3 going forward, I think this is a really good spot for E3 right now because we've got a good summer of building, getting the project off the ground in terms of the pilot prototype. And in the fall, we're going to have some fantastic news about the operation of that prototype and moving on to the pilot, as well as developing that process for lithium hydroxide. So that pretty much wraps me up. I know I'm probably just running out of time as well. This is a great summary slide for the company, so I can end it here.
Great. Thank you very much, Chris, for the informative presentation.
Absolutely.
We'll now open it up to questions. Just a reminder to the audience, if you have any questions, feel free to submit them through the chat box. We do have a couple of questions to start off. First, what additional steps do you have for permitting for the project?
Absolutely. So permitting happens in stages. Permitting is actually one of the biggest assets that this company has in terms of external factors. We're likely to fall under Alberta's oil and gas regulator called the AER. And just to give you an example of the permitting process there, a well license is what you require to extract the resource. It's attuned to a mining license. Generally, they're about 4 to 8 weeks to get after you've applied for a well license. You need a pipeline license, obviously, to move the fluid through the ground, and then you need a facility license as well to build and operate your production. So there's effectively three licenses that the company will operate under with this project. Obviously, there's a time frame to that, but relative to hard rock mining or that in Canada, the oil permitting regime is very streamlined, very mature, and designed to move very quickly here in Alberta.
Great. And another question, I guess, would be about the initial CapEx for the project and what all is involved in building and potentially financing.
Absolutely. So the CapEx we outlined was $600 million. It breaks out about a third between the brine production, which is effectively the wells and the pipeline. Another third is the pretreatment in the DLE. And then the last third is the production of lithium hydroxide. We assumed in this 100% drilling our own wells, just to be conservative. There's probably opportunity here to take on existing sites, either that's wells or the well site, or even a potential old oil and gas processing site and well as well. And that would reduce capital as well as reduce the permitting timeframe. But for the purpose of the PA, we didn't include any of that. In terms of financing, I think it's going to most likely be a combination of several different things. We're talking to some strategics about supporting that, and that could be in the form of offtake, right, or something like that, that supports sort of an equity injection. Most of the capital, construction capital for the project will likely come out of a debt. And I think that's why it's really important to have very strong metrics for this in terms of the operating costs, for example. In terms of the price that we use is very robust. I think even today, you could argue that that's a solid price for today, as well as the jurisdictional risk. And so you bring all of that together along with a very solid ESG plan. I think that's the attraction for debt financing. And those discussions, they take a long time, so they've already started as well.
Great. All right. Well, that's about all we have time for today. I want to thank you again, Chris, for the presentation, and thank you attendees for your time and participation today as well.